Hi, everyone. Welcome to the program a little bit early. My name is David Toll. I'm the publisher of Private Equity Career News, and I'll be your impresario for today's program. So thanks for joining us a little early. We want to reward you for doing so with a few insider tips on how to make the most of the program. You all should have a control panel on your screen, and that's where everything happens. So one of the things to look for is the question feature. That's where you can ask questions of the speakers during the program, so please avail yourself of that. Also, toward the bottom, you should see a handout drop down, and that's where you can find a copy of today's presentation slides. And there's also a survey report from a survey that we did last year of business development professionals on best practices in the industry. And that's really cool, so make sure that you download that. So we'll get started in about 3 or 4 minutes. In the meantime, I thought I'd let you get some insights into the personal lives of our featured speakers. I want to hear, let's see, first from Nadim Malik of SBS, our sponsor on the program today. Nadim, what's a hobby or hidden talent you pursue outside of work?
I would definitely put them in the category of hobbies and not talent, but pretty straightforward: golf and guitar. I think you can see a couple of the guitars here behind me. My son was a senior in high school, started taking him lessons about 10 years ago, and I thought it'd be something fun to do together, and we've stuck with it. He's moved on to the electric. I'm staying, with the acoustic, and it's been fun. I've even done a few open mics in a crowd of 5 or 10, and they haven't booed me off stage. So that's kind of my hidden hobby, I would say, not talent.
What's your favorite song to do?
Oh, my favorite song are something with Neil Young or Bob Dylan or Bob Marley. When I'm really feeling soulful, but
I love it.
I don't want to subject anyone to that. I'm the one who enjoys my playing the most, so I've learned from my family.
I love it.
Nadim, do you sing along when you play?
I do. I can carry a tune that helps. That makes it a little more fun. And my teacher just says, "Hey, what song do you want to learn?" And we just learn songs, so it's not bad.
Okay, very cool. Well, we also have a featured speaker from Hidden Harbor Capital Partners, John Caple. John, what's a hobby you pursue outside of work?
I do a lot of offshore fishing. So, down here, I live down in South Florida. The fishing here is great. Unlike up in the Northeast, where you sort of have to go 60 miles out to actually get to the canyons where it's tough enough to really do blue water fishing. Here, it's a mile offshore. So and my son is 14. He loves to go fishing as well. So that's where I spend most of my time outside of work.
Yeah, very cool. Drew, we have Drew Collina of Stifel. Drew, what's something you pursue outside of work?
Well, I played guitar for 6 years as a kid, but can't carry a tune and got rid of it very quickly. So that I wouldn't consider that to be a talent at all. In fact, that was for me more of a waste of time. But I spent a lot of time with my family, and I think if I had a talent, I don't have many. I'm not very confident at many things, but I'm a pretty good ping pong player. I don't know why. I played tennis as a kid, and I think I spent a lot of time in the fraternity playing ping pong. And I don't have a ping pong table, so I don't get to do it very often. But it's the one thing I can walk into a room and feel confident about. Everything else is a mess.
Okay. So a latent talent for ping pong.
Yeah.
And beer pong, it sounds like.
Maybe.
And Sash, what's a hobby you pursue outside of work?
Well, it's so funny. I feel like my son is a really good guitar player. He did his own band. He's got his own band. It's kind of punk. So I'm not sure I like the music, but his guitar playing's pretty good. And my wife's cousin was one of the top ping pong players in China. So I don't have these talents, but I'm pretty basic with keeping my kids sane and just watching them, along with I love fishing and golf, and keep it simple. But that's what I enjoy.
Okay, hearing a lot of common themes here between ping pong and guitar playing and golf. You guys sound like you could be fast friends. All right, so let's get started with the program. Good morning and welcome to a special Private Equity Career News webinar, Adapting Deal Sourcing Strategies to Thrive in 2024. My name is David Toll. I'm the publisher of Private Equity Career News, and I will be your moderator for the program today. I'd like to start out thanking our sponsor, SBS by Bain & Company, for making it happen. SBS is an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. A few housekeeping announcements before we get into it. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything they say today in an article. Second, you can download a copy of the slide deck from today's presentation from your control panel. There's a handout drop down. You can also download a copy of the results of a 2023 survey of business development professionals with valuable information on industry practices. Later today, I will send you a recording of the program, so no need to take extensive notes. And finally, many of you asked questions of our panelists when you registered, and we will plan to address those during the discussion portion of the program. Please also feel free to ask questions at any time during the program through the question feature on your control panel. If I don't interrupt the program to ask it, I will save the question for the final 15 minutes or so. Okay, I'm super excited about our program today. I'm very grateful to have 4 expert speakers to guide you through the topic. We have John Caple, based in Boca Raton, Florida. He's a partner at Hidden Harbor Capital Partners. Drew Collina, based in Boston, is the head of middle market and lower middle market sponsor coverage at Stifel. We have Sash Rentala, based in New York City, although I think he's in Florida today. He's partner and head of financial sponsor coverage at Solomon Partners. And Nadim Malik, founder and CEO of New York City-based SBS by Bain & Company. After we get through brief introductions, Nadim will present statistics describing the state of the M&A market, and he'll also address the role that technology plays in helping deal originators see a higher percentage of relevant transactions. Okay, let's just find out a little bit more about our speakers, starting with John. John, just briefly tell us a little bit more about Hidden Harbor Capital Partners, the investment strategy, and your role there.
Yeah, so founded Hidden Harbor about 8 years ago with at the time 2 partners. We're now up to 6 total partners. We're currently managing a $450 million fund. We do lower middle market value deals in industrials and business services. So paying on average anywhere from kind of 5 to 7 times for deals. As I said, all in industrials and business services, and continue to be quite active. We also buy primarily kind of founder family-owned businesses and corporate carve-outs.
Okay, super, John. So obviously, John is on the sponsor side of things, and we also have 2 investment bankers on the program. Drew, tell us a little bit more about Stifel and your role there.
Sure, and thanks for having me. I'm not sure why anybody would want to dial in and listen to me say anything, but it's an honor to be here and with these other guys that are on this panel who I know well. So I greatly appreciate that. Stifel, we're a middle market investment banking firm that provides M&A services, leverage finance, debt advisory, private placements, and a lot of other services and products across multiple industries for investment banking firms and others, focused on traditional transactions in the corporate and institutional market.
Okay, super, Drew, and we're grateful to have you on the program. Sash, tell us a little bit more about Solomon Partners and your role there.
Yeah, hi everyone. Yeah, I run our private equity coverage effort here at Solomon Partners. I've been here on the platform about 4 years. Before that, I ran the middle market practice at Moelis. And we are, Solomon just simply was the old Peter Solomon business, which was a consumer retail focused platform. Natixis purchased half our stake, half the company, and we've been on an aggressive build over the last, I would say that deal happened in 2016, the last 8 years or so, expanding beyond consumer retail. We're now in multiple verticals, targeting private equity, corporate carve-outs, corporates, focused primarily on the middle market, which is really we define as sort of that, a mix of founder and private equity owned businesses from 20 million of EBITDA up to 100 million, the 200 million to $1 billion market. And we continue to grow.
Okay, super, Sash. All right, let me turn the program over to Nadim Malik of SBS by Bain & Company to introduce himself and present some data to shed light on the current state of the market. Nadim?
Awesome. Thank you to our moderator, David Toll, for coordinating all of this. Thank you to my fellow panelists. And thanks everyone for joining us today. Hope everyone's year's off to a good start, and that you're enjoying some nice spring weather. Unfortunately, here in the New York area, it's not that nice today, but we've had a good taste of some nice spring. So we enough to give us conviction that it's here to stay. At SPS by Bain & Company, we're continuing to do what we do best, which is helping our clients position themselves for relevant deal sourcing opportunities in the current or any given market using data, analytics, technology, and automation. Well, deal activity in the PE and M&A world continues to be down, but are there finally signs of life? Are we now on the cusp of that long-anticipated surge of deal activity? What impact will this year's elections and what the Fed decides to do with interest rates have? I'm really looking forward to hearing the perspective of our panelists who are great at what they do and have been doing it for a while, each of them grappling with many of the same questions as our audience. But before turning things over to them, I wanted to spend a few minutes just walking through some slides to help frame our conversation. Beginning with what you see in front of you here, which is overall private equity and M&A volume. Now that the dust has settled on 2023 full year data, we can offer a more accurate comparison year over year. And 2023 was down 16% for the year. It's important to note that despite this decline, deal activity came in at the third highest level we've ever seen since we began tracking the data. Also worth noting that the trend that began in 2021 of PE overtaking and representing a larger share of overall M&A activity versus corporate buyers continued and strengthened in the last couple of years, with PE activity now representing 55% of overall deal activity in 2023 compared to 53% in 2021. With more financial investors and PE funds continuing to pop up, I'm wondering if this trend is ever going to reverse. Moving on to the next slide, the quarterly numbers offer some valuable insights. Looking at quarterly closed deal activity over the last few years, it's hard to ignore the ascent that began in Q2 2020, which was the peak of COVID, to its summit in Q4 2021 in terms of quarterly deal volume, and then that downhill trend since then. However, deal activity in Q4 2023 was up 6% compared to Q3 2023, breaking a 7-quarter streak of quarter-over-quarter down deal activity. While the picture on Q1 2024 deal volume is still incomplete due to data lag, As it stands right now, it's coming in at a pretty healthy pace and may end up higher than Q4 2023 and Q1 last year. Moving on to the next slide. Here's a look at the most active sectors over the last 3 years, broken out between strategic and private equity deals. Industrials is the most active sector, replacing tech, which was the most active sector in 2021, but has seen a significant decrease year over year for the last 2 years. Industrials deal activity is down pretty much in line with the overall market after actually increasing in 2022. Business services was the third most active sector and was down significantly in 2023 after coming in more or less consistent the prior 2 years. The sectors with the least decline year over year are healthcare and energy, and private equity has the edge over corporate buyers in all of the top 5 most active verticals, while the financial services, energy, and media and telecom sectors saw a higher share of strategic versus private equity deals. Moving on to the next slide, the trend of the buy and build and roll-up strategies in private equity continue to accelerate, reaching 2.7 add-ons for every platform in Q1 2024 so far. That compares to 2.5 add-ons for every platform last year and 1.4 add-ons per platform about a decade ago, almost doubling in that time. It'll be really interesting to see how far this trend will continue. Will we surpass 3 add-ons or maybe 4 for every buyout? I think it's really hard to ignore this trend if you're a PE firm, and we're certainly seeing an increasing focus on it on the deal sourcing side with our clients. On the next slide, looking at private equity activity only and breaking down the sectors by the 4 deal types we track, which are add-ons, buyouts, recaps, and financings. Financings is what we call non-change of control transactions. The business services, healthcare, and financial services saw the greatest add-on activity relative to other deal types in 2023, while financings continue to remain an important investment strategy in the technology sector. Add-ons are also taking an increasing share of activity relative to other deal types in the industrial sector. Add-ons comprise the biggest share, if not an outright majority, of all transaction types for most sectors and are the key contributor behind PE activity, representing a higher share versus corporate buyers of overall M&A activity for the last 3 years. Let's now take a look at private equity pipeline data. The median number of deals that private equity firms saw or logged, perhaps more accurately, in their pipelines was 187 in Q1 2024, up from the prior quarter, which is no surprise, though, given how the fewest number of deals tend to be brought to market in the final few months of the year. But what is promising is that Q1 2024 deal flow was up over 20% compared to Q1 2023, which is a more relevant comparison. While these numbers can't speak for quality, it does suggest that deal flow is trending positively purely from the perspective of volume. Moving on to the next slide, there's a lot of interesting takeaways here to unpack. Let's start with the data point that there were 880 unique intermediaries that sold at least one business of approximately 10 million or greater in EV in the US and Canada last year. That compares, in case anyone's curious, to 908 intermediaries that were active last year, which may lead you to think that there wasn't a lot of change in active intermediaries, but that's not the case at all. In fact, according to our data, of the 880 firms that were active, 143 were brand new. They sold a business for the first time in 2023. And over 380 that were active in 2022 did not do a deal in 2023. That's a total churn of over 500 firms over the course of the year. And that's just at the firm level. It would be even greater at the professional level. So literally every day, multiple things are changing in the intermediary landscape, which begs the question, how often as a PE firm are you, cleaning up your contact data or kind of re-tiering your intermediary coverage? I can tell you that keeping contact data current is both a challenge and huge focus at SPS because we know how critical it is in forming the right relationships in a timely manner on a continual basis. And before leaving the slide, I just want to point out on the right side, you see the most active sellers, 2 private equity buyers on change of control, new platform deals in 2023. I'd be remiss if I at least didn't point out the concept of broad versus limited processes. When you look at these names and the SPS proprietary sell-side process index confirms that most of these firms tend to run, well-run, broader processes. On the other end of the spectrum and on the way in between, 69% of the active firms close 3 deals or less. And these are often more below the radar, quiet processes run by boutique firms. Very challenging to cover this ever-changing landscape, but if you have the people in place and the right tools, it can really give you an edge in seeing deals that maybe your competition does not. Let's move on to the next slide. I'm still loving this slide. This shows the top 25 sell-side advisors, irrespective of size or buyer in 2023, in terms of number of deals, further breaking down their deals by size range. I'm not sure what the right commentary is for this slide, but honestly, it's just fun for me to look at and hope some of the audience enjoys it too. I will say that the firms Generational Equity and Benchmark International do stand out on the lower end of the market, which we call sub 50 million in EV, while JP Morgan, Goldman, and Morgan Stanley jump out for me for the upper end. Moving on to the next slide. What we're showing you here is a small sample output as an example of SPS Prism. This is a new premium offering available only to SPS clients, and it includes various views into target market deal activity and a client's market coverage. By evaluating year-over-year trends in relevant deal activity against the effectiveness of a client's deal sourcing function, Prism provides a deeper and more nuanced picture of what's impacting deal making and how to make the necessary adjustments when compared to just raw data alone. Some of the reports you see here include market coverage trends year over year for the last 3 years by deal size and seller type in the client's target market, as well as a more detailed competitor analysis, including market coverage by competitor. This is also showing some analysis and trends around the relevant intermediaries in the client's target market. And finally, moving on to the next slide, here's a preview of our 2024 deal sourcing data book that's coming out in the coming weeks. We're very excited about it. This is something we produce every year. It's a collection of market trends, data analysis, business development resources that we think are the most compelling and timely and can help shape a firm's strategy in the coming year. There's nothing compared to a specific set of customized analysis which we can deliver to our clients. However, we think the data book can reveal strategic themes and tactical insights that may impact your approach. What you see here is a snapshot of the 50 to 500 million EV market, looking at top PE buyers broken out by deal type, the most active sectors by sell-side process type, meaning broad, moderate, or limited processes run by the intermediary, and then sell-side intermediary by sector comparing 2022 versus 2023. With that, I'd like to turn it back to our moderator, Mr. David Toll, and our panelists for our discussion and Q&A.
Really good stuff, Nadim. And Nadim, you're so close to all the data, and we're seeing hints of maybe a turnaround. What is your outlook for the rest of the year? What are you thinking in terms of deal volume?
Well, you're going right into it, huh? It's really hard to predict these kind of things, but if you add what I'm seeing in the data with the conversations I'm having in the last 2-3 weeks, which seem to suggest an uptick in deal flow, then I think it's safe to say that, well, I don't know if it's safe to say, but it looks like deal volume is going to increase, not dramatically, but potentially increase this year over last year. So, and that's quite a statement. As a reminder, even though deal volume has been down 15% or so 2 years in a row, last year was still the third highest we've ever seen. So to increase off of that would be pretty significant. So I think it's going to be slightly up.
Okay. Thanks, Nadim. Well, we have such a large audience today. We're going to take advantage of the intelligence in the virtual conference here. I'm going to ask a polling question related to deal volume, and that is, how do you expect the number of platform deals that you could close this year to compare with last year? So just give me a moment to launch the poll.
Wow, I would have expected more to say it was higher.
Okay, it looks like the polling feature kind of malfunctioned and we didn't get very high response. So I'm just going to hide the results. Maybe give it another try. No, the poll is closed. Well, we'll have to move right into our discussion portion of the program. And the first question that I have for our featured speakers is, what is the quantity and quality of deal flow like out there right now? I'm going to start with John on the sponsor side of things, and then we'll move to hear from the investment bankers on the program. So John, you're first up. Quantity, quality of deal flow, what's it looking like out there?
I mean, I think you got to separate the world between kind of founder family-owned businesses and private equity-owned businesses, which between the two of them make up sort of the vast majority of deal flow in the middle market. So on the founder family-owned side, that market is almost always steady Eddie, right? It'll go up and down a little bit, but founders tend to sell, kind of when they're ready to retire, when they're ready to spend more time with their grandchildren, and they don't wait for sort of the next move by the Fed or the market being in the right place. So that market feels steady Eddie to me, maybe a little better. I think the big question is when do private equity sellers really start to sell their businesses? And this probably really is more the 20 plus $100 million plus EV kind of deals that 2 years ago were going for teens and even teens kind of multiples. Today that market is a lot better than it was then. And the question is, when does that market come back? I think the issue that market has right now is that with interest rates where they are, you can't get 6 and 7 turns of debt on your deals anymore just because fixed charge doesn't work. So you're down to 5.5 turns of debt. So you've taken a turn to 2 turns of debt away. That means valuations are down a turn to 2 turns. Which may be fine, and you'd say, hey, that shouldn't really stop deals. The problem is private equity's all marked their book kind of with the old multiples. And so if you're marked at 14, it's hard to sell at 12, even if selling at 12 gets you a perfectly good return, because your LPs are going to say, wow, if this deal sold for 20% less than where you'd marked it, isn't your whole book worth 20% less, and how do I think about your whole fund, et cetera, et cetera. And so on the one hand, LPs really want liquidity. On the other hand, they don't want you to sell things below the mark. And until those two things kind of come together at some level, I think the market is still going to be, pretty thin. My guess is those things start to at least come together when we get the first interest rates cut. Who knows when that's going to happen? I think we all thought it was going to happen in June or so, and now it's looking much less sure. So that's kind of my view.
And John, as the owner of many portfolio companies, what's your thinking in terms of selling? To the extent that you have some portfolio companies that that would be ripe to sell. When are you thinking about the timing of those sales?
I mean, we'll still move forward and try to sell things even in this market. I think in addition to buyers being reticent to come out, just the sellers being reticent to actually sell. A lot of private equity buyers haven't put a lot of money to work over the last kind of little while in new platforms. And so, they're looking for sort of the perfect thing. And so I think, if you have a great A asset, it'll still sell for a very good price. But as soon as you get to the A- B+ kind of stuff, it's harder. So we're still looking to sell things. We'll probably run 2 to 3 sale processes this year. It helps that we bought a lot of these things at much lower valuations. And so, we don't need to sell it at 14 times to make it make sense. We can sell it 10 or 12 or what have you. So that's what we're going to do. But we may be in a different situation just because of where we bought a lot of these businesses.
Okay, nice. Well, let's move to the investment bankers. Same question, and starting with you, Drew, quantity, quality of deal flow for you guys right now.
Sure, and to John's point, which was a very good one regarding, excuse me, the split between privately owned versus private equity owned. From that context, what my job and our role is at the sponsor coverage practice at Stifel is private equity oriented. So my data points and view comes more from the private equity perspective than it does the privately owned business perspective. If I take a quantity first, per Nadim's presentation and the data around Q1 and where the numbers seem to be falling out, I think that's fairly consistent with what we've seen and what I'm hearing in the market. As a data point, our Q4 pitch activity accounted for roughly, in 2023, since I guess Labor Day, 45% of our pitch activity was in the back half of that year, which is, if pitches are a leading indicator to M&A activity, which we all think they are, it makes sense that Q1 would be more active. Now, on top of that, I would say that our pitch activity in Q1 reflects that of Q1 in 2023, which is not nearly as robust as years past that we still hang on to, like 2021 and even 2022. So I'd say that the deal activity, the deal flow metrics, based on what I'm seeing, though I hear that things are going to pick up, to address and reflect on what John was saying, there still continues to be a valuation gap between buyers and sellers. And so until that shrinks further, I think that it will be modestly up to your panel question, and maybe it wasn't right, but I predicted it would be this kind of the same, and that's where it fell out. Now, as it relates to quality, the A assets are still garnering a tremendous amount of interest, and the valuations continue to be very high. The debt markets are available for those types of deals right now. There's a scarcity value in the market for deals like that right now. And again, to John's point, there's a lot of people with capital that they want to put to work. But if it's a B or a C, the valuation gap is more apparent, and it's a little bit harder to get those deals done.
Okay, thank you. Thank you, Drew. And Sash, from your perspective at Solomon Partners, same question: volume of deal flow, quality of deal flow right now.
Yeah, look, it's very similar to what Drew and John said. I was going to say, when you asked John what he should do, what he should have said, he's going to hire Solomon Partners for all his deals, and he didn't mention that, but. I think the key thing that we're focused on is close rate. When we decide to take on a mandate, last year was brutal for the market in terms of close rate. We've talked to good clients that do a lot of volume, and some of them were like 2/3 to 75% of our sell sides that we launched last year just couldn't get done. And it was to John and Drew's point about the value gap, because these marks are set at 21 levels and 20 levels, which were very high and elevated. And it's just math. When the financing markets have changed, It just makes that value gap significant. And, you know, now you've got sellers that need to sell, they need to get money back. They're motivated to sell, but they are kind of, you know, quite frankly, a little burned from last year of not getting their deals done, and they don't want to look bad in front of their LPs, and they don't want to run inefficient processes. So, you know, and that's probably what's leading to the audience saying we're kind of flat, which was not a great year. And there are, you know, and the other thing I'd say is it does depend on size of deal. There are some large cap transactions out there that are relying on the syndicated markets that were done with very high multiples back at the peak. And the syndicated markets are on fire right now. So, you know, you've got some leverage. And the question is, are these liquid large deals going to transact? And if they do transact it at a lower value, maybe 1 to 2 turns lower than mark, will the sponsors transact? And, you know, the thinking is if they do transact, it will go and reverberate throughout the market where there will be sort of a reset where it's almost acceptable for LPs to just say, look, we're a turn lower, but we get our money back. And that may reset into the middle market. And the middle market, I think, has been much more frozen relative to, you know, the founder market for sure, and maybe the large. We've seen some large M&A deals get done in Q1. So that actually leads me to more positivity that with the large liquid market starts to clear, you might see that reflect in the middle market. And to John's point, the founder market's still been pretty active because there's just a lot more flexibility with these founders.
And Sash, so that sounds fairly reassuring, but looking ahead to the rest of this year, Sash, what's your firm's thinking about interest rates, the impact of the election? What's your outlook for deal volume for the rest of the year, given those big factors?
Yeah, look, Drew made the comment. I mean, pitch activity is solid. People want to sell and they want to hire their advisor and they want to get ready. The question is timing and when they launch. I mean, if they don't launch soon, kind of mid-year, you're really going to be tough to close by the end of the year. Just processes have been taking a long time to get done. You know, your question about election, it's interesting. We're going to a lot of meetings and the election stuff versus the last time around, it doesn't come up as much. I have a feeling that as it gets closer, there may be, let's wait till January to launch kind of thing, but it's a lot less than what it was in the previous election. I guess the entities are known. No one's really happy with Egypt's choice, but I think they're known entities and what's going to happen. So we just have less of that conversation. And then in terms of our activity, it's solid. I think we're very focused on taking on assignments that will close. If we, to Drew's point, it's a very good one. If we have a really good asset, it's a supply demand issue right now. There's just not enough supply for, you know, GPs need to deploy. If there's a really good asset, it's actually going for a very solid multiple, even with lower leverage ability. So, you know, if we have an A asset, we want to get out there. We think we can get a good price. But the thing is, there's just not enough of them to really generate overall volumes to get to a level of certainly 21, but you know, even better than last year. So we're thinking it's probably flat is my guess as well, and with maybe a potential higher close rate.
Okay, let's turn to talking about individual industries and subsectors within industries. And we're really after, you know, what are some of the industry trends and industry subsector trends that are generating deal opportunities for private equity firms right now. And we'll start again with John at Hidden Harbor. What kind of investment themes are you really excited about now, John, and see heating up?
Yeah, look, I think field services, industrial maintenance, all those kind of nice asset light, recurring, acyclical industrials and business services industries are sort of where we're seeing the most activity. both at the larger kind of middle market shops that buy things from us, as well as some of the smaller guys. So, to me, that's the place where private equity is really playing, doing a bunch of these roll-up strategies. My guess is Nadim's data, by cutting it off at 10 million of EBITDA, probably understates the number of add-ons that are getting done out there, because there's a pretty active market in these kind of sub $10 million location add-on deals that folks are doing. And so, we're clearly seeing a lot more buy and build activity, and I think sponsors are focusing on industries where that's possible, because those deals are still very, very doable at the right valuations with a ton of leverage available.
Okay, so field services, industrial maintenance, all very interesting to Hidden Harbor right now. Drew, what are some of the industry subsectors that you're seeing a lot of activity in, and by the same token, what's maybe cooling off?
I would echo exactly what John just said. I think one of the hottest spaces at our firm right now is business services, broadly defined, but that's commercial and industrial services across field services and roofing and HVAC, and I mean, you name it, and janitorial, elevator services. I mean, I think they're all they've been hot for a couple of years now, but they're still incredibly popular. At the same time, they're also saturated. I mean, I feel like they're hot markets, but a lot of them have passed a bit. However, the valuations expectations remain the same. It's very hard, we're seeing, for the private equity world to find the next services space that hasn't yet received institutional capital. And I think in terms of deal sourcing for those listening to us, finding that next asset light service subsector that needs consolidation that hasn't had institutional capital is a gem. It's just hard to find. I mean, pools, who would have thought 5 years ago that, pools would have been one of them. And so they continue to be out there. I think John's right. There's still great value for them. But it's hard to find. And I can't add anything else to what he says. It's a consolidating space. Frankly, a lot of it's founder owned, which is a great opportunity for consolidation as well. It's just finding the right valuations in there to roll up those businesses.
And Drew, what about on the flip side? What was hot a few years ago and now it's just dead crickets?
I think that's the cyclical stuff. There was some consumer product businesses, consumer durables. I mean, we can go back 5 years, were more exciting than they are today. Asset building products was a hot space that seems to have cooled off a little bit, maybe coming back. Those are two of them that come to mind for me.
Okay. And Sash, same question for you. What industry-wise seems to be hot, and what's cooling off?
Yeah, look, I think John probably would agree, and I tell this to internally. I think investing, post 21, like the bloom's off. In 24, these vintages, 24, 25, 26. I mean, they're going to be incredible times for private equity if they can deploy. That's the challenge. And I think, a lot of these deals that were done in 21, these, HVAC roll-ups and healthcare services, DSOs, all this stuff, there will be pockets of deals within these sectors that, either are over-levered or they need a solution that you can buy into them at a much cheaper value than 21, and they may be very, very good deals. There's also a huge 25 maturity wall with regard to debt. 24 was actually pretty modest. So I think there's going to be some challenges with a lot of these companies coming up that are the underperformers, that from a private equity, if you've got an angle in terms of, creating value on some of these, just because it's a bad capital structure, it's still a decent company. And the other areas are, to Drew's point, I actually think, our consumer retail group last year was the busiest of any of the groups at our firm. And really, and I think this is going to be reflective of the rest of the other sectors, is what's happened is a lot of those markets set to a new level. Retail is like at 5 times in terms of multiples. So when everything resets in value, we were working on multi-billion-dollar mergers of just, when things get reset, deals start to happen because people understand where value is. So I think you're going to see that roll through in other sectors where the value gets reset and then people are like, we got to do deals. And I think all that's coming over the next few years.
Yeah, I was going to say the other sector I think comes back this year is transportation and logistics, because it's been dead for 4 years. You had the massive spike in rates, during COVID. I mean, if you owned a truck brokerage firm in 2022 and you didn't triple your EBITDA, like, I don't know what you were doing, right? But all the smart buyers knew that was happening, and so you couldn't sell anything off those spike levels. Then they came down, and I think all the folks that were making all that money thought, oh well, it'll bounce back, and it won't. So my guess is over this year we're finally going to decide, hey, transportation rates are kind of where they're going to be for the foreseeable future, and you're going to have a lot of deals done because you haven't been able to do a deal for 4 or 5 years. So that's another place that I would be looking to do transactions here in the next year.
Hey, John, also getting back to what Sash just said, I know Hidden Harbor has a taste for distressed, special situations, complex situations. Are you anticipating, sort of a bit of a restructuring wave and companies over leverage that are going to need, solutions and assistance?
I mean, it's funny. I've been in this business for a long time, back to the 08-09 financial crisis, and every time we're going to have a coming wave of restructurings, it sort of never happens, right? Because it's almost always worse for the lenders to actually go through with a restructuring. Like in 08-09, amend and extend was sort of all of us talking about how stupid the banks were, and it turns out it was really smart. It actually worked. You never got that kind of huge a wave of restructurings, even in that deep of a financial crisis. So, we do look at deals with some hair on them, but it's more founder family owned businesses, corporate carve outs. They tend to be actually really good underlying businesses that just need professionalization or a carve out or what have you. So that's been more of our focus. And look, will there be a few more distressed deals? Maybe, but that's been a tough market to play in for a long time.
Okay. Well, if there's one thing I've learned in covering private equity and buyout deals for 25 years is that you need open and healthy credit markets for deal activity to occur. So Sash, I wonder if you would give us sort of the overview on how cooperative the credit markets are being right now, and what do leverage multiples and interest rates look like on deals?
Yeah, look, I mean, last year was interesting as the Fed over 2 years raised rates, as John mentioned. It really created some dynamics in the credit markets which were negative to private equity. Just math: higher interest rates, more costly, less leverage, and that really proceeded through, I think, even Q3 of last year. And then what was interesting is you've got the syndicated markets, and then you got the private credit. And private credit, as we all know, has just boomed. And there's a lot of private credit available. And the big banks were actually getting pretty concerned that they were losing market share on the larger deals, private credit. So it was interesting. It started in Q4 last year. Certainly Q1 of this year, the syndicated market has been really active. And the syndicated deals, there's been a lot of activity. And I think a lot of it's just due to supply and demand. There's not enough deals for these banks to put their money out. So they've been very aggressive. And they also want to try to get back market share from private credit markets. And then, this year, you've got a really strong syndicated market. The private credit, and John will attest to this, I'm sure Drew will too, that there's for good companies, John could probably go to his 4 or 5 best relationships and get a good financing package available to fund his deal. And I think that supply-demand dynamic where there's not enough good deals, but there's a ton of supply with regard to private credit, especially in the middle market. I think that's going to continue, and you're going to see solid availability this year with regard to leverage. Now, clearly, it will not be 21 levels. The stats I saw was almost a 3/4 turn reduction in overall leverage on the median LBO since the peak of 21. So you've seen a turn reduction, let's say, in overall leverage, which is obviously going to impact valuations. So, but the capital's there, and I think it's going to continue to be there.
Yeah, I'd really differentiate between the syndicated and high yield markets, which really open and close, where, at certain times there's just nothing available. Private credit never closes. There's always stuff available. All of these private credit funds are raising funds that have, in many cases, 2 and 3 year kind of life cycles. And so they have to put money to work. And so those markets have never shut. The problem is that you can just get a turn to 2 turns less leverage. And I think it's probably more than the 3/4 turn because the better deals are getting done now. So my guess is it's a turn to turn and a half less leverage. I mean, they're still very available. Even for B and C assets, you can go get leverage. It's just less. And so, and I don't know that that's going to change until the interest rate environment changes substantially. And I don't know that that's going to happen. Even if you get a rate cut or 2 this year, I don't think 50 basis points does it. Because the issue is really just fixed charge coverage, and 50 basis points doesn't solve that problem.
Thanks, John. And Drew, to the extent that there remains a gap between buyer and seller expectations on pricing and valuations, what are sellers looking to get in terms of valuation multiples, and what are buyers looking to pay?
Well, sellers are still trying to get 2021 multiples, and it's we talk about this a lot internally, which is, and it's understandable, right? It's my comparison to try to break it down to the simplest possible is, if your neighbor sells their house for $1 million, you look at your piece of property and you say, well, mine's worth at least $1 million. Look at the upkeep, and for them to tell, for a realtor to come in here and tell me mine's only worth $850, well, screw those guys. So it's just inherent. That's what you think, and it makes sense. John's nodding his head. You put your heart and soul into these businesses that you acquire. It's a natural progression to just fall in love with them and think they're worth a lot. And oftentimes they're worth a tremendous amount of money. Sometimes they're worth less than the seller thinks they're worth. So bridging that gap, particularly now, is challenging because it was a very short time ago where all these businesses were worth an exorbitant amount of money, where everybody just kind of scratched their head and said, holy smokes, we should just put ours into the market. Did you see what that one sold for? So it's very hard to bridge that gap. I think it's a game of math to some degree, and the leverage is what the leverage is. What we're seeing more in discussions, it doesn't mean that it's coming to fruition, is earnout potentials, and it's a discussion topic now to bridge some of that gap, which hadn't been on the table for the past couple years. It doesn't mean that it's being embraced, but it's a tactic that people are discussing to try to bridge some of that valuation gap that still exists.
Drew, so does private equity fall in love? Like, absolutely. There's no doubt about that. So I couldn't agree with Drew more. My sense is the valuation gap today, though, is not that. It's that people are holding it at 14 because they bought it at 14. And even when they know it's worth 12, it sort of doesn't matter. They can't afford to sell it at 12, even if they've doubled or tripled the EBITDA and they'll make a good return because of what it says to their LPs. And I'm not sure that's going to change. You're right, earnouts can help that. The real solution is the continuation vehicle, right? So, and for those of you that don't understand, the way the continuation vehicle works is I sort of essentially sell the company to one of these funds that does CDs. I stay in control of it, but my existing investors kind of cash out for these new investors. And it works because everyone knows continuation vehicles pay kind of 90 cents or so on the dollar of marks. And so if I sell to a continuation vehicle, even at 85 cents on the dollar, I could go to my LPs, well, you know, that's how continuation vehicles work. And you really want liquidity, right? So it's good for you. On the other hand, you know, I can then sell it at a discount and argue that the rest of my stuff also shouldn't be marked at a discount. So it's all hand waving, but that's actually what I see happening, and the continuation vehicle market is exploding, right? So, but it's all kind of hand waving to pretend that everything's still worth 2021 values, right? So that's what I'm seeing actually is the solution. And you know, those markets are very, very robust. And frankly, you know, like the CV investors are the same people that invest in my fund. It's kind of wild if you think about it. So that's what we're seeing happen a lot out there. And the question is, do those CVs sort of make any sense? Because right, like the other option, if you don't like where it's going to trade versus the mark, is just to hold it longer, which private equity is also doing. So, yeah. By the way, the institutional LP world hates all this stuff, but
that's a great point. The CV thing's a great.
I was just going to add. I was just going to add to John's point. You know, we actually went to a dinner with like 8 of John's peers, and the question was, you know, do you sell at a turn or two low if that's where what the bidders say? You know, that's what the market says. And hands down, all of them said can't, because we just can't re-rate our entire portfolio. So they turn to continuation vehicles. I think the only nuance with the CV market is it's great if you can get it done. The secondary funds have definitely raised a bunch of capital to get CVs done. However, they are extremely picky in trying to consummate a CV deal. The other thing we're seeing is structured deals just to get some money back to their LPs. They'll do a structured piece of paper and layer it in, and that seems to appease. And valuation seems to be less important there. It's more about where they sit in the capital structure. But that seems to appease the LPs for a little bit until they can, you know, hopefully this market changes, rates come down, maybe 200 basis points. I don't know where it changes the math, but that's another option that we're seeing, and we're doing some deals related to structured products.
Thanks, Sash. So let's change directions a little bit and talk about company performance. John, you've got a whole portfolio of companies there at Hidden Harbor. Give us first a sort of an overall flavor for what your portfolio looks like and some insights into how the companies are performing.
We have 14 portfolio companies today, sort of reasonably broadly across industrials and business services, although probably more focused on those kind of higher quality service businesses that we talked earlier. Through March, we were up 8-ish% on revenue, more like double digits on EBITDA ahead of budget. So look, I think broadly speaking, the economy is doing quite well. Our businesses are doing quite well. We're seeing great add-on activity. We did 17 add-ons last year. We have a bunch lined up for this year. So I think the economy is actually pretty healthy, at least what we're seeing.
Okay. And John, you mentioned you will probably do some selling this year, maybe a handful of companies. In general, would you say you're more excited as a buyer in this market or as a seller in this market?
How do I think about that? I don't know that I really think about it that way, interestingly enough, right? Like, because it all depends on, like, our businesses, we buy a lot of founder family-owned businesses, you know, $5 million of EBITDA, and then through add-ons grow them to 20 to 30. And so from our perspective, that's our job. And once we've sort of done our job, it's time to sell. And so, we're going to continue to do deals this year. We did 3 platforms last year. We'll do 3 to 4 again this year. 17 add-ons last year. I don't know that we'll hit that number, but we'll probably get pretty close. You know, ideally at this point, we'd be selling the same number of businesses. I don't know when we'll get that done either, but we're probably going to, on balance, buy a little more than we'll sell, but it'll be close.
Okay, super. So let's turn to sort of the nuts and bolts of finding transactions and sourcing deals. We've got about 15, 20 minutes left in the program. So please, if you have some questions, make sure to ask them now. through the control panel question feature, and we'll definitely have time to address those in this last portion of the program. But getting into nuts and bolts of deal sourcing, Drew, what are some ways, especially young business development professionals, can provide value to you and make their calls something that you welcome rather than dread?
Never dread, never dread. I think I'm in a unique position to answer this question, having spent 3 years on the business development side many years ago, when in the middle market anyway, I think there were maybe 15 business development people back in that day. It's certainly changed since then, with multiple nuances. And I don't know, I think the last I saw, there's 400 or 450 business development professionals now. You know, I think for the most part, if we being the investment banker, when we run a broad process, if we're doing our job right, we're, you know, to some degree boiling the ocean with potential private equity buyers. So the traditional investment banking firms, I think, for a fund like Hidden Harbor, you know, that's a tier 1 relationship probably for Sash, and it is for me as well. I mean, there's only in the rare circumstance would they ever not see a transaction from us. I think the harder part for the junior business development person is building that rapport with maybe it's a firm like Stifel or like Solomon Partners, or maybe it's a smaller boutique M&A shop. And what's valuable to them is understanding the portfolio, and it's equally valuable to us. Being the business development person that calls and says, "Hey, what do you got for me?" Is really exciting for one phone call, and then the relationship quickly becomes one directional. And what we're trying to find out is, how can we help you with your investments, add value, and be considered an expert in the space when it comes time to sell the business? And if the business development professional is able to do that with, whether it's myself, whether it's a sector banker, whomever, they are providing a much more valuable part of a relationship and becoming top of mind than if all they're doing is saying, "Hey, can you send me your books? Because I just got to hit a number of how many deals I'm seeing."
Okay, John, you have the challenge of getting on the radar of some of these smaller boutique investment banks and making sure that you see all the deals. It doesn't sound like it's going to be a problem seeing Stifel or Solomon Partners deals, but what are some of the best practices and tips that you have for those junior BD professionals?
Yeah, I mean, I think it's thinking about, you know, how do I make Drew and Sasha's job easier? And so on the one hand, it's knowing your own portfolio really well, understanding where Stifel and Solomon and the bank you're talking to, where they have strengths, and making sure, you know, the biggest thing that Drew and Sash care about is getting in front of your sell sides. And so helping them understand where they can spend time with your portfolio and where you should interact is actually what those guys want by far the most. And so that doesn't help you source deals, but if you help Drew and Sash do their jobs, they're going to help you do your job. And so it's sort of that simple. I then think when it comes to sourcing deals, it's exactly what Drew said. "Hey, what do you got for me?" is like really not effective. "I am really interested in X" is very effective. And "Hey, I'm really interested in X. Can you hook me up with your industry banker so that we can talk?" And then when you get on the phone with that industry banker, you actually know the space and know what you're looking for. That's where you really get on the list, right? Because is it true that these middle market banks blast out their deals to 200 firms? Oh, yeah. Is it also true that they have a list of like 20 guys who they really think know the space and they want to make sure they do a good job with? Oh, yeah. And so you want to be in that list of 20 for the stuff you really like and know. And so to me, that's the critical thing. And that's hard to do so the thing is that's harder to do as a business development person, because you may not be, you may not know that stuff as much as the investment team. And so the very best business development relationships really connecting the right investment team members to the right industry bankers at these places. And so Drew and our BD person are really like the middlemen that are just trying to create those correct connections. And so the best BD people aren't interested in owning relationships, they're interested in making connections in the right way. By the way, as true as that is with Stifel, it's also true with the small guys. The more you can tell them how they could be helpful to you and then where you can be helpful to them and make those connections, the better. And so even if you're talking to a one-man shop in, in Grand Rapids, Michigan, telling them, hey, we're really interested in HVAC, oh, you have something? Can I get you on the phone with our partner to have a really good discussion is a great way to do it. And so it's all about making the connections, knowing what they want, knowing what you want.
Yeah, I was just going to add just to that. And by the way, Hidden Harbor is a solid tier 2.
The truth is we don't pay enough for solid. So we're like tier 1 to sell our businesses and like tier 4 to show us businesses. And that's okay. We get it.
What I was going to say, what Hidden Harbor does really well, and it's to my point, is they are a known brand, and they've done it the last 8 years, where, the broad auction is actually getting more and more limited. The deals are almost cut like well before, like in a way, because they know who the top 10 buyers for this asset should be. So when we're getting a request, we get it at least 3 or 4 times a week. Who should be on this list? And who should be the tier 1? Or who should be the top 10? And what Hidden Harbor's done really well, and other firms too, but is branded themselves to say, we are known for X. And that's not just with the BD person or with me, it's with our industry, the relevant industry teams. And then when they say, they said, oh yeah, of course, Hidden Harbor should be tier 1 for that. And that's not me saying it, it's our industry guys saying it. That's when the BD person has done their job, and they've effectively built their own brand themselves. And I think that's where I think you become very effective as a BD person.
Okay, thanks. Thanks, guys. All right, no webinar these days would be complete without some mention of artificial intelligence. So that's where we are in this program. Nadim, I think you're probably best positioned to talk about how the advent of artificial intelligence will impact the deal sourcing efforts of private equity firms this year and into the future. Tell us what you're seeing.
Yeah, I'm happy to kick it off, and then would love to get the thoughts from our panelists as well. So our parent company, Bain, recently led a webinar to review its global private equity report. And one of the things that it was very insightful, but one of the things that stuck with me and really stuck out is they did a study of fund performance or deal performance attribution in this last cycle. I don't know if they looked at the last decade or 7 years or whatever it was. And the results of the study showed that half of the performance attribution came from multiple expansion and half came from revenue growth. So and there was nothing that came from margin or operational improvement. And I think that's going to be the big difference. Sash made a great point. If you can find a way to get deals done in last year, this year, these vintages are going to do really, really well. And when you have like the John Caples and the Hidden Harbors of the world that are comfortable, beyond the innovation that occurs in, finding alternative sources of capital, maybe equitizing a deal a little extra, these types of things are very important. But getting into the operations of a business and finding ways to improve that and grow, I think that's going to be a big, when you look at this study 10 years from now, I think you're going to find a big disparity between the great performers and the not so great performers that were ones that were actually able to operate their businesses and improve. And, that's something PE firms haven't really had to do in this last decade. And and the things that they could have done a decade ago are going to be different now. And so where am I going with this? Among the areas of operational improvement, I think you have to look at AI, and it's an opportunity to create efficiencies. It's an opportunity to accelerate growth. So I'm a business operator, and it's a little bit like the wildcat days of oil and gas. There's no playbook. You got to figure it out on your own. You got to go to different webinars. You got to read different articles. You got to try different things, and you really got to allocate the time towards it. And there's going to be a competitive advantage. It's the buzz of AI has worn off a little bit, I would say, in the last few months, but the promise is still there. And we're looking at, and it doesn't necessarily translate into reducing headcount always. Like, for example, in our business, we found we are discovering ways to increase efficiencies in our data collection, to increase the breadth of data and the accuracy that we create. And that doesn't necessarily mean we need less people. It means that we can accelerate and grow in areas. For example, if we want to grow our coverage to Europe, which we are doing, and grow our product line in other ways, we can leverage AI and get some of that, opportunity to do that. So I think AI is going to play an important role on the operations side, and John can speak to it, and some of the bankers can speak to it. On deal sourcing and business development in general, I think we're in the early phases. I don't think any private equity firm has been on the cutting edge, as far as I know, that's deployed AI to find a deal that otherwise got missed. But I think it is some firms that we work with. We work with several hundred private equity firms at any given time to help them use data and technology to optimize their deal sourcing. We work with some of the best BD professionals in the world. So we're in those discussions, and people are definitely trying to figure it out. And I'm sure they will, but nothing just jumps out quite yet on the deal sourcing side.
Thanks, Nadim. John, are you, turning to ChatGPT for any daily advice or tips, or how do you use AI there?
So I have a whole bunch of thoughts on this. So first of all, exactly what is AI? So let's start with the fact that AI is the newest buzz phrase that everyone attaches to everything to sell it for more. So there's a huge element of just nonsense to this, right? And so what is AI, right? Like, the computer's been able to beat humans at chess for 20 years? Is that AI? So of course that's what they'd call it, right? And if you're trying to sell your product and your product is a chess engine, you'd call it an AI-enabled chess engine because, I don't know, it seems computery, and so let's call it AI. So there's a start of, like, what exactly is AI? If what AI is fundamentally these large language models, I think is what we're really talking about if we're talking about AI. Well, then the question is, like, what real commercial applications do they have yet? And sort of the answer is, outside of writing my daughter's term paper, it's not clear what it is. And so, you've seen a couple of really interesting efforts by business to sort of use AI for chatbots to answer customer service calls that have actually been really effective. But outside of that, it hasn't really had a big impact. And, will it? Probably. I mean, but I think we're still, like, a long way away from it. And if you're a lower middle market guy like me, the question is, like, we got a bunch of big technology companies and a bunch of big other companies plowing millions and millions into this. Like, the odds that I'm going to figure it out in my little company are really low, and all the little people I buy. And then the second question is, is private equity ever going to get, margin improvement? And the answer is, I don't know how you figure out that, like, half of the value is revenue growth and half of it's multiple expansion, because those are inextricably linked. And the real answer is that the market will pay you a lot more for revenue growth than they will for margin expansion. And so if you're a private equity guy, investing in SG&A to get revenue growth at the expense of margin expansion almost always is the right thing to do. And so that's why I think you're seeing that out there. And then the other point I would make is that the businesses we buy, these $5 million founder-owned businesses, like, the value in simply putting a CRM system in is extraordinary. like a basic Salesforce system. I'm talking like Salesforce basics, you know, and I can significantly improve revenue growth just by doing that. And that's a 20-year-old technology, right? Forget AI. Like, they're so far away from that, it's crazy. So, you know, is AI going to have a big impact someday? Yeah, maybe yes, maybe no, but I'm sort of skeptical it gets to HVAC installation companies in the next 5 years. Right?
Okay, fair enough. And turn to Drew. There was quite a bit of interest, as there always is on these programs, people that sign up for them. How do you preempt a sales process? How do you get into a deal before it actually comes to market, and you know, grab it for yourself? Is that happening out there, Drew? What's going on?
Yeah, John says, I want that deal, and I'll hire you to sell my next portfolio. That's how you do it.
Okay, there you go.
Oh, I'd say that, but
oh, I know. I think that has become the holy grail of deal origination these days, right? Is trying to get a preemptive look at something where you feel like you are out in front of any competitor before anything. I think the way you do that is, if you're a business development person, you do exactly what John was saying, which is you make interactions with either the sponsor coverage guys to ultimately get a connection between the sector bankers and your investment team to talk content, trends, and everything else, so that they build a relationship around things that are coming to market that you and he or her may be tracking. There is a greater tendency today than I think it's sort of maybe a 5-year trend of private equity firms talking to private equity firms, and business development professionals at private equity firms talking to other business development professionals at private equity firms. It's not ideal for Sash and I suppose, but it's a way to get out in front of things and build rapport around investments that may be coming to market in 3 or 5 years, and begin dialogue ahead of time. There are more and more deals where we pitch and win the pitch, where once we begin the process, they say, all right, we got to include these 5 private equity firms because we've been in dialogue with them about this business for the last 3 or 4 years. And that's very, very helpful from a sourcing perspective.
Okay.
Yeah, I would say it's like it's all about, once again, it's all about knowing these industry subsectors. And so if Drew and the team at Stifel, or Sash and the team at Solomon knows that I love pest control, this is what I'm looking for, they're going to then, you know, be dialoguing with me about what they have coming down the pipe. And that's where, you know, look, as a seller, there's a big part of me that just wants to run a broad auction. On the other hand, if a legitimate buyer that really knows the space comes to me with, you know, it doesn't have to be this massive number, but what seems like a fair number, and I can avoid a process, that's not always the worst answer in the history of the world. And so you probably are going to have to pay a reasonably full value, but if you have a strong thesis in a space and you want to get into it, oftentimes it's a way to preempt an auction, and you know, maybe you end up, you know, paying what the auction would have been, but you avoid sort of the chances you lose it, and the seller avoids, you know, going through the pain and agony.
Okay, everyone, we're down to our last minute of the program, and I'm going to give John the final word. John, we want to hear about just a favorite portfolio company, under the radar, maybe just does interesting things, growing like crazy. Just tell us a little bit about it to end the program.
Oh, okay. Well, sort of our probably top performing company right now is a business called Avtron. They make what are called load banks. And so if you can imagine, you have a big data center. In the back of that data center, you have to have a backup power generator. It's kind of a big diesel engine. You actually have to test that backup power generator about once a week, and the module that tests that is called a load bank. And so we bought the business in a corporate carve out from Schneider Electric about 18 months ago. you know, as you can imagine, with renewable energy, the grid is getting less stable, and the grid is getting less stable, and you simply need more backup power generation. Add AI and just the insane build out of the data center market, and the company's growing like a weed. And so, you know, we've kind of completed our carve out, and we're pretty excited about it. EBITDA is more than doubled since we bought it already, and a super compelling asset that we're really excited about. So I'd say that's one, and then we're continuing to be super successful with these kind of field services roll-ups. We have a couple pump maintenance businesses, HVAC, fire life and safety, restoration. You know, we're playing in all these spaces and seeing a lot of success.
Okay, super. So hopefully, John, when we have you back on one of these programs in a few years, we'll ask you about Abtron and how it turned out.
Absolutely, absolutely.
So I'm afraid we are out of time. I'd like to thank everyone for coming. Particularly like to thank our sponsor, SBS by Bain & Company, and Nadim Malik for making the program possible. I'd like to thank our speakers for doing a bang-up job with the program. Drew Collina of Stifel, Sash Rentala of Solomon Partners, John Caple of Hidden Harbor Capital Partners. And enjoy the rest of your day, everyone. Thanks for coming.
Thanks, everyone. Enjoyed it. Thank you.
Thank you.
Thank you.
Thanks.